In this video, we'll talk about some additional terminology. We'll also talk through how transactions affect the accounting equation. So what is a transaction, you might ask? Well, that is a business event that can be measured in terms of money. For example, if a company buys an office building for $100,000, the event is buying the building and the monetary measurement is $100,000 in this case. So the business buying a building is a transaction of the business. And then we have an account, which is a written record of the increases, decreases, and balances of an item. For example, a cash account will only have cash transactions. So any transactions that were paid in cash or any services that were provided in cash, you got an increase of cash that'll show up in the cash account as well. And then we have these GAAP principles and assumptions. Now we have in our notes that the GAAP or generally accepted accounting principles are a set of principles used to prepare financial statements in the U.S. And our class will be mostly discussing GAAP. Now the first principle we have here is the historical cost principle, which says that assets are recorded at the price paid. And this can also be called the cost principle. So if we go back to that example of a company buying a building for $100,000, even if the company negotiated the price from an original $200,000, since the company paid $100,000 for the building will go on the company's books at $100,000, and the amount will not be changed for any increases or decreases in market value. The amount of the building will stay the same as the company has possession of the building. Next, we have the time period assumption, which says that for reporting purposes, businesses divide the time into artificial periods, so it could be months, quarters, or even years. And then most companies are going to follow a calendar year in, but some may not. So companies like to make sure that they have their fiscal year end at a different time if they are busy at December 31st. So a company might decide, oh, I'm less busy in March, so my year end will now be March 31st, and that's what they'll call their fiscal year end. So their fiscal year runs from April 1st to March 31st each year. The last assumption we have is the entity assumption, which can also be called the business entity assumption. And all that says is that only the company's transactions are recorded in the books of accounting for the company. Their owner's transactions are not recorded in the business accounts or included in the financial statements of the business. And that's the same even if a company interacts with many entities. Only the transactions of that specific company are reported in the financial statements and the books of accounting. So how do transactions affect the accounting equation? We'll have some examples down here to go through, letters A through G. And I've already written down my expanded accounting equation. So assets equals liabilities plus common stock plus retained earnings. I just need an underline. So in letter A, we see the company being formed on January 1, year 1, and ABC received $80,000 of cash from issuing common stock. Well, let's take the first piece. The company was formed on January 1, year 1. So we have to start with a beginning balance for this company. So we're starting at 0 across the board. The company didn't start with any assets, liabilities, common stock, or retained earnings. So now in letter A, we see that the company received $80,000 of cash from issuing common stock. So we have cash as an asset. If the company is receiving $80,000 in cash, it means cash is increasing. and then cash was increased because common stock was issued. Therefore, $80,000 includes the common stock. So we have $80,000 assets and $80,000 of common stock. Therefore, this accounting equation is in balance. So we can move to letter B. So then we have ABC Company receiving $200,000 cash by borrowing money from a creditor. Right? So the company is receiving $200,000 cash. Cash is increasing. But what's the cause of the increase? The company is borrowing money from a creditor. We know that when a company borrows money, they have to pay this back later, and this is called a liability. What type of liability is it? It's a note. So we have $200,000 in assets and $200,000 in liabilities. So our accounting equation is in balance. We can move to letter C. Letter C, ABC Company paid $60,000 to buy land. So the company is first paying out money, so that is a negative in the cash account because cash is decreasing, money is going out. But then the company is paying that to buy land. And because of the historical cost principle, we know that these assets should be recorded at the price paid. So the company paid $60,000 to buy land, therefore our land is increasing by $60,000. Now, this is a special kind of transaction where we have an increase and decrease on the same side of the accounting equation. So because we have a positive $60,000 and a negative $60,000, we have a net zero on the asset side, and now we still have zero on the liabilities, common stock, and retained earnings side. So we are in balance and can move to the next transaction. So in letter D, ABC Company earned $90,000 by operating a parking lot on land. So the company earned $90,000. We are going to assume that it is in cash, so our cash is increasing. And how did the company earn this money? It was operating a parking lot on land. That to me sounds like revenue. And we know that which of these are affected by revenue. Retained earnings are affected by revenue, and revenue has an increase effect on retained earnings. So we will say a positive $90,000 in retained earnings. Right, letter E, ABC Company paid $68,000 for operating expenses such as salaries, utilities, maintenance, and interest. So the company is paying $68,000. That is a negative in the cash account because cash is going out. And then what is the cash being paid for? Operating expenses. Which of the pieces of the accounting equation are affected by expenses? Is it assets, liabilities, common stock, or retained earnings? It's retained earnings, and expenses have a negative impact on retained earnings. Letter F, the company paid $5,000 cash dividends to its owners. $5,000 cash is going out. And dividends affect retained earnings, so retained earnings are being increased by the dividend payment. Then lastly, letter G, the land that was bought in transaction C had an appraised market value of $80,000 at the end of the year. Do we change the price of the land? No, because of the historical cost principle, we are leaving the land at the amount paid. So now if I look at my totals across the bottom, let's see if our accounting equation is in balance. On the asset side, we have $237,000 in cash and $60,000 in land, so that gives us a net $297,000 of assets. On the claim side, we have $200,000 in liabilities, $80,000 in common stock, and $17,000 in retained earnings. So a net $297,000. Our accounting equation is in balance and all is well.